This is level 1 of the CFA program, the topic on alternative investments, and module 2, performance calculation and appraisal of alternative investments. Let me just quickly remind you what we did back in module 1. This was pretty much a kind of a broad stroke as an introduction of alternative investments. And although you might remember that I did give kind of a partial mathematical example, and I said we get to it some other day. Well, today's that other day. Look at that second LOS. We're going to have to calculate. So let's get out our calculators, although the math in the slide deck here is relatively straightforward, so we might not even need a calculator. But we'll go ahead and start with issues in performance appraisal. So let me give you my introduction here. Look, if we go to the floor of the New York Stock Exchange and we buy at 100 and sell at 110, we can clearly compute that 10% return, holding period return on that particular security. Well, remember back in module 1, we talked about all of the unique characteristics about alternative investments. And those unique characteristics, for example, generally low levels of liquidity, clawbacks, drawdowns, all of these unique characteristics make performance appraisal in the alternative investment universe a little bit more challenging. They're not super difficult, but we need to pay attention to some of the details. So why is it challenging, right? Unfavorable characteristics. So there's the word illiquidity that I just mentioned. Asymmetric risk return profiles. All right, so what do we talk about in our regular old traditional finance theory? We talk about, in general, 2 dimensions of the risk expected return profile, where we have standard deviation on the horizontal axis and expected return on the vertical axis. And, in 2 dimensions, we can identify a linear relationship like the capital market line, or a nonlinear relationship like the Harry Markowitz efficient frontier. But inside of the alternative investments, we may have to go more than just those 2 dimensions. And we'll talk a little bit about that as we go through this slide deck. Product complexity, of course, we're including things like real assets and derivative securities, limited portfolio transparency, and then a complex fee structure, which we'll do in the last couple of slides here in this deck. So look at that second block point. This is what I was just saying. If we take a look at a normal distribution where we have the expected return, well, we can call it the mean return there, standard deviation and beta, they may provide us with an incomplete picture of that risk return profile. So we might not be able to look at the linear or the nonlinear relationship. We might need to look at some other issues. There are some more examples: lockup periods, redemption rules, and differences in reportings. And so remember, in learning module 1, we talked at length about the advantages of alternative investments. Remember things like diversification, things like a better risk return profile. But of course, there is no such thing as a free lunch. So what are these disadvantages here? Low portfolio liquidity. Do you remember in the learning module 1 recording, I gave you the example of the 8 or 10 or 12 miniature golf courses along the eastern coast of the United States. Boy, how much liquidity do those things have? It's way lower than a share of McDonald's stock. There's probably use of loans, so we have high leverage and derivative securities in there, product complexity. Although I believe that part of my responsibility in delivering these recordings to you is to decomplexify. I'm not sure that's a word, but I'm guessing that you know what it means. To decomplexify what the Institute and what lots of people in the financial press think of as complex financial securities. But it's my job to kind of chop them into their components. So if you have a simple component, a simple component, and a simple component, taken as a whole, those 3 components might look complex, but individually they're not. Limited transparency, the great example here is, of course, hedge funds. We're told what the hedge fund manager is going to invest in terms of, maybe a broad stroke, but it's not until the release of the actual investments sometimes later that we know what those investments are, what the proportion of the investments are in terms of relationship with the whole portfolio, and then what those values are. And then go back to my miniature golf course example. Boy, how the heck do you know what the value on today's date of a miniature golf course in Fenwick, Delaware is going to be? So limited transparencies, and that includes mark-to-market issues. How do we value these? If we're marking to market on the floor of a derivative exchange, we probably know what those values are on a day-to-day basis, but it's clearly not in alternative investments. Limited redemption availability and high fees. So how do we appraise the performance? So these are performance measures, and I'm guessing you remember our conversation on the Sharpe ratio, in which we're really trying to look at a ratio based on the relationship between risk in the denominator, so there's portfolio standard deviation, and return in the numerator, excuse me, where our return is going to be some type of a premium. So look in the numerator, we're going to take our portfolio return, which has some level of risk, right? That's reflected in the denominator. And we're going to net out, we're going to subtract out the risk-free rate of return, because you can generate the risk-free rate of return without taking any default risk. So think of that numerator as some type of a portfolio risk premium. And so what do we want? We want lots of numerator and little denominator. This goes all the way back to Harry Markowitz in 1952, where what are we trying to do? We're trying to combine these essentially mutually exclusive objectives of minimizing risk and maximizing return. Those of you who know anything about Excel, you can use Solver to put together Harry Markowitz's efficient frontier, and that's pretty much what you're doing inside of the constraints. So look at that first arrow point in green. Higher the Sharpe ratio, the better the investment. So think about comparing two alternative investment funds. What you're going to do is you can take a look at the Sharpe ratio for each of them, and you want to choose the better one or the higher one. Now, because standard deviation is in the denominator, we're assuming that the distribution of returns follows a normal distribution, which means that it can be fully described by its mean and its standard deviation. So the Sharpe ratio is based on normal distribution. Now, the problem, of course, arises in that when we look at fixed income securities and equity securities, we probably don't get a normal distribution, but you might remember from our quantitative methods readings that I probably mentioned my own kind of personal term. In the fixed income and equity markets, we get kind of like a nearly normal distribution. And so it's not perfectly normal, but it's nearly normal. That's my term. You'll never hear that on a CFA exam. But you can, because it's nearly normal, you can kind of get away with it or make some adjustments to it to be able to make some pretty good, reasonable predictions. But in the alternative investments market, here, let me go back here. Because of all of these disadvantages, alternative investments are probably not nearly distributed. In fact, they might be far away from normal distributions. So we need to think of skewness and kurtosis in there. And so the Sharpe ratio might not be the best way to evaluate the performance of an alternative investment. What's the advantage? I mean, this is super easy to calculate. But another disadvantage is that because we use standard deviation, which measures the distance from the mean return to all of the other returns, if we're going over a historical period, and so it takes a look at the upside and the downside risk in an identical manner. So what we need to do then is we need to say, is there something different out there? Now, the something different, it might or might not be better. This Sortino ratio is generally considered to be a more appropriate measure of performance for alternative investments because all it does is look at downside deviation. So look at the ratio. You still have the same numerator, right? The return on the portfolio minus the risk-free rate of return. But now instead of computing the standard deviation, which looks at both positivity and negativity in relation to the mean return, we're only going to compute the downside deviation. And you compute the downside deviation exactly like you do the standard deviation, except you eliminate all of the positive returns. And so in the squared term of the downside deviation, you're not going to subtract it from the mean like you do with standard deviation, but you're going to subtract it from, maybe zero, or maybe the return on a treasury bond. So what this does, this Sortino ratio, this adds an extra value so that we're only looking at downside deviation, because investors in general, not just fixed income and equity investors, but also alternative investors, are interested in answering the following question that sounds something like, okay, if I have $100, how much can I lose? Can I lose $5? Can I lose $10? Can I lose $100? Well, that's going to be captured in this measure of downside deviation. And so it's possible then that this Sortino ratio is going to capture maybe some skewness, and probably not, but maybe even some kurtosis that the Sharpe ratio ignores. But look at that last arrow point. What we also are worried about is whether or not there is a positive or perhaps negative correlation between and among the alternative assets and the traditional assets. And so neither Sharpe nor Sortino capture that correlation coefficient. That's a really good potential exam question. So then we ask ourselves the question, boy, can we get even more unique and specific in this alternative investment performance measure? And of course, we'll go to the Calmar ratio, which is short for the California. This was developed by a manager in California. And then the managed account reports, that's the MAR part of the ratio. So these are considered to be better alternatives. What we're doing is we're comparing the performance to a drawdown. And so think about this. Suppose that you send me your money and the value of our portfolio is $100. And over time, that value drops to, 98 and 94 and then 90. Well, we're not quite sure what the drawdown is until we get back up to 100. So if we drop to 90 and then we get back up to 100, then we know that drawdown is, what was that, 10 or $10 or 10%. So we're going to compare that performance to a drawdown. And then we can have a maximum drawdown, which says something like, you know what, you guys, when you send me your money, you're going to say, you know what, Jim, we don't want to lose more than $20 out of that 100 or 20%. So the Calmar ratio is comparing the average annual compounded return to that maximum drawdown. So the higher the Calmar ratio, the better is the risk-adjusted performance over a time period. And you can do this over any time period that you want, but kind of the convention, or maybe the best practice, is to look at just 3 years of performance. That's kind of the standard for the Calmar ratio. But the individual MAR ratio uses the entire history and that maximum drawdown. So remember the difference between Calmar and the MAR ratio. Those two differences, the maximum drawdown, and compare them then to Sharpe and Sortino. And then we can have another measure of performance there. Just forget about everything else on the slide. Just look at the ratio there. So let's look at the numerator, realized value of the investment, and the unrealized value of the investment. Forget about the tax implications of these things just for now, and divide that by the total amount of invested capital. That gives us a multiple of invested capital ratio. This is primarily used in the private equity market and for real estate performance appraisal. Sometimes it's called a money multiple. It's super easy to understand. That's why I went to the ratio first. But what it does is that it ignores the timing of cash flows. And we know how important that is based on our conversations back in, regular time value of money stuff. We want to know what that holding period return is, and we want to know what the holding period is. So it's similar conversation to what we had before. All right, how about some fee arrangements? If I'm a mutual fund manager, just a regular old fixed income or equity mutual fund manager, I'm going to tell you exactly what my fees are. And those are pretty standard and easy to compute. Morningstar gives you those very readily and easily available. But if I'm managing, let's suppose I have a portfolio, I'll go back to my 10 miniature golf courses. I am managing these 10 miniature golf courses. And I have a forest over here as well that I'm managing. And I'm also active on the floor of a derivative exchange. All right, so what am I going to do? How am I going to be paid? How are you guys going to be comfortable paying me? Because of, I need to be experts in miniature golf. I need to be experts in sawing down trees, and I need to be experts on marking to market. And let's go back to one of my favorite all-time movies. Surely, I hope you guys have watched Trading Places with Dan Aykroyd and Eddie Murphy. So I have to be an expert in orange juice productivity and orange juice futures contracts. All right, so this fee is based on liquidity terms and asset size. So assets under management, and hedge funds may charge different fees depending on, what is liquidity, what is the size, are there agents out there? We also need to consider whether or not we're looking at a startup firm. So there's a founders class shares. Notice that arrow point there, the dark arrow point. That's usually applied to probably the first $100 million, but that limit could be almost anything. It could be 10 million or it could be a billion, but 100 million seems to be, kind of the standard. And then there are either or fees. So, I can charge a management fee, or I can say, instead of charging me a management fee, then why don't you allow me to be compensated for my performance, which we may agree on a hurdle rate. So you can do the either or, you can do both. You could pay me anything you want, really. And so that's going to be outlined all in that legal contract that we both agree to. Remember, I'm the fund manager. You guys are my investors. Depending on the arrangement, whether it's a hedge fund or private equity with the general partner or the limited partner, remember, think of these alternative investments. We could have any kind of arrangement that we want, but the Institute is pretty much focused on, what shows up in this learning module, and that's what we have on the slides. So let's go ahead and get out our calculator, even though we might not need that here. So let's go ahead and take a look at this. We have hedge fund manager. So we have 100 in assets under management to start with. Just look at the timeline down there. So at the end of period 1, we've grown that to 120. The end of period 2, we haven't done so well. It's fallen to 90. And at the end of period 3, it's gone back up to 140. So let's go ahead and do some kind of a fee structure. Look at the bottom diamond point there. We have a 2 and 20 fee structure. I'll tell you about that here in just a second. And there is a high water mark provision for the incentive fee. So remember, that's 2% and then 20%. I think we did this just briefly back in Learning Module 1. So let's go ahead and do the math. I'm not sure if you need your calculator here, but it's nice to have it handy. So look at what we've done from period 1 to period 2. We've made $20 million. So what is my management fee? So that's the 2 part of the 2 and 20 fee structure. So I take 2% of the ending value. So that gets me 2 times 12 is 24, right? So that gives me 2.4 million that goes to the payment for the management fee. But then notice that I have increased the value of the fund by 20%. So I'm going to take, as the fund manager, I'm going to take 20% of that $20 million. Think of that as kind of the capital gain. And there's the 4 million. So the total fees for the period 1, 2.4, and 4 gives me $6.4 million that we pay to me. If I'm the fund manager, you guys are my investors. What is your return to the investor? So what did I do? I delivered 20 million out of 100 million. So we know that's 20%, but then you had to pay me the 6.4. So the management fee and the incentive fee, they eat into, kind of that original capital gain. So the return to my investors, 13.6% for that first year. How about the second year? Oh boy, we lose 30 million, right? We went from 120 down to 90. So my 2% management fee is going to be 2% of the ending value, right? The 90 million. So that's 1.8 million. There is no incentive fee. And so I'm paid as the fund manager just a total of 1.8. So notice that you lost 30 million out of the original 120. So what is 3/12, right? That's 25%. So you lost 25%, but then you lose a little bit extra more because you had to pay me the management fee. So your loss is 26.5%. So let's go to period 3. This is where we're probably both going to be more happy, right? So we go from 90 to 140. So that's a $50 million. So my management fee is going to be 2% of the 140. So there's the 2.8 million. But now here's where we need to be careful. What might I say? I might say something like, well, we started with 90. We ended with 140. That's 50 million. But you're going to say, wait a minute, Jim. And here, let me just go back here real quick. Notice that very last sentence there, with a high watermark provision for the incentive fees. So where am I here? In end of period 3. So you guys are not going to pay me to go from 90 to 140 because, look, you already paid me an incentive to go from 100 to 120. So you're only going to pay me in excess of that high watermark, that 120. So that's 20 million. So I'm going to get 20% of the 20 million. So we take the 2.8 and the 4. So my fees, I get 6.8 million in total. And so notice that you guys got 50 million. During this period, you got 50 million over the 90 million. So that's, what's 5/9? So that's over half, but you have to pay me that 6.8 million. So your total return is less than half. There it is, 48%. So this gives you a really good sense, and these are simple examples here. These are very similar to what the learning module examples are inside of the reading. So calculate and interpret those fees and the returns. You should be able to do that. Now, the total, if we want to sum these together, we have the fund growth from 100 to 140. That gets us 40 million. Management fees are 7. Incentive fees are 8. So that gets us up to 15. So essentially, what did we do? We went from 100 to 140 million. So I generated a capital gain of 40%. There's the 40 million over the 100 million, but you ended up paying me 15 million. So that eats into your 40% return. So you're down to a total return over that time period of 25%. All right, notice that what we just did in that previous example was for a before fee. That satisfies that first part of the LOS. But then notice the second part says, how about after fee basis? So let's go ahead and do just a quick example here for period 1. And you can do periods 2 and 3 on your own. The mathematics is pretty easy. So let's go ahead and do this net of the management fee. So the first calculations are identical. Let's go ahead and start with 120 minus the 100. So there's our 20 million in bold. Management fee is then 2% of the 120. That gives me the 2.4 from the previous example. But now when we compute the incentive fee, we need to take that 2.4 out of the 20 million. So look next to the equal sign, we have in parentheses 20 million minus the 2.4 million. Times the 20%, that gives me the incentive fee just of $3.52 million. So the total fees then are the 352 plus the 2.4, that gives me 5.92. So look at the return to the investors. There's the 20 million divided by the 100 million. So that's the 20%. Remember I said kind of like a capital gain, but then you're paying me the 5.92 million. So that gets us down to just 14.08%. And so let me just go back here kind of quickly. What did we have here? There's the 13.6 that we did with before fee base, and then now we've got the 14.08. So clearly that benefits you as the investors, and it not punishes me, but it reduces my return. And that takes us through the 2 learning outcome statements for Module 2. But these probably have equal importance, so make sure that you can describe those performance appraisal models, the Sharpe model and the Sortino model and those other handful of models that we do, but also be able to calculate and interpret returns. So what I want you to do now is I want you to go to the end of Module 2 and take a look at, I believe there's 8 end of module multiple choice questions there, and some of these are super easy. You'll look at these and say, yes, Jim, of course you taught me this. That's perfectly easy to answer. But I like there's 2 or 3 of them in there that have big question stems, so you have to read multiple sentences, and this will be really good in preparing you for level 2 and for level 3. And I'm guessing the Institute is moving towards that kind of a testing model where the questions in level 1, the question stems have more, let's say meat and potatoes to them rather than just skeletal questions. So anyway, have a great day. I've enjoyed this recording. Hope you did too. And good luck studying.